Good morning and welcome to today's board meeting. We have one item on our agenda today, an agenda decision related to an EITF issue application of topic 715 to market return cash balance plans. With that, let me turn it over to our team to tee us up this morning. Good morning, team. And Michael, I believe we go to you first.
Thank you, Rich. I will first tee up question 1 on the agenda criteria decision. Earlier last year, an agenda request was submitted to the EITF on the application of 715 to market return cash balance plans, which are a type of cash balance plan with variable interest crediting rate based on investable market returns. The agenda request noted that there are different interpretations of measurement guidance in subtopic 715.30 related to discount rates that could be used to measure the projected benefit obligation of market return cash balance plans. As a result, the accounting may not reflect the economics of these plans. The EITF added this project to its agenda in April and made its recommendation to the board in September, as listed in paragraph 8 of the handout. On the basis of the EITF's discussion, the staff believes that there is an identifiable need in practice to improve GAAP on this area, that there is a technically feasible solution that is perceived to better reflect the economics of market return cash balance plans, and that there is a limited and specific scope of types of plans to be addressed. In addition, the staff notes that the number of cash balance plans, including market return cash balance plans, has been growing and evolving since 2001, and the EITF expects those plans to continually grow and be more commonly implemented. Therefore, the staff observes that the FASB's agenda criteria are met and recommends that the board add a technical project to its agenda to address the discount rate used to measure the projected benefit obligation for market return cash balance plans. I'll now turn to the board to discuss question 1.
Great. Thanks, Michael. Any questions for the staff on question 1? Okay. Not seeing any. Sue, can I start with you this morning, please? Question 1.
Sure. Thanks, Rich. So first of all, I appreciate the EITF's efforts in addressing this issue and all of the legwork that they've done on it. I will agree to add it to the agenda. I do think that they've demonstrated that certainly there's an improvement that they think is needed. And I do think that certainly for those companies that have these types of plans, there's diversity in practice and application, et cetera, much like Michael, what you described. I don't necessarily think it's as pervasive of a problem as perhaps is articulated. I agree that the volume of cash balance plans has increased, no doubt, based on your statistics, but this type of plan is much smaller subset of actually all cash balance plans, and typically you see them in smaller service type entities, that some of which may not even actually prepare GAAP statements. But having said all that, for those who have these and those entities of a certain size that have these, it's an important issue. And so based on the EITF's recommendation, I would vote to add this to the agenda. And it could be that, because there's guidance that's put in place that's actually more clear, maybe it might be incentive for others to adopt these types of plans.
Okay. Thanks, Sue. Joyce?
Thanks, Rich. Good morning, all. So I'd also like to thank the EITF for addressing this issue and bringing forth recommended narrowly scoped potential solutions. As it pertains to question 1, I support the staff recommendation to add a project to the technical agenda. I agree that the staff has identified the agenda criteria, and the criteria has been met. The potential solutions that the EITF has put forth are specific regarding the types of market return cash balance plans that would be within scope, and we'll talk about those conditions shortly. I think, and I agree with what you've also mentioned, Michael, that the solutions are expected to better reflect the economics of those plans as identified by the EITF, and it is directly responsive to the diversity problem that the EITF has identified. I think quite importantly, the staff research points out that the current pension accounting has deterred some entities from implementing market return cash balance plans, partly driven by what is viewed as the uneconomic reflection of the benefit obligation in the financial statements, and considering the more legislative friendly and tax advantageous environment that currently exists for these types of plans, essentially making it overall condition friendly, if you will, to convert to these types of plans, more appealing to plan sponsors. I think it's important to address what some plan sponsors view as an impediment, and that may be caused by the accounting.
Okay, thanks, Joyce. Marcia?
I also appreciate the efforts of the EITF and all of their deliberations, which led to the recommendations that we're going to discuss in the following questions. I agree with the application of our criteria to add this project to our agenda. With regards to Sue's comments on the fact that we're talking about something that may not be broadly applicable at this time, I do agree that the case has been made that clarifications would be an improvement to GAP, so I support the project.
Okay, thanks, Marcia. Fred?
Thanks. I also support adding the project, and I think the ETF has identified a narrow scope and a workable solution. I think it's interesting, though, that this does underscore the evolution of pension plans, because I think essentially what all cash balance plans is, they're a hybrid between defined benefit and defined contribution. And as a result of them being a hybrid, neither one of the accounting models we currently have really work. I think this is a step towards addressing what in likelihood will be a broader issue over time, and that is the need to have essentially accounting fit for purpose for these hybrid type of plans that as we face them. So I think that while, yes, these market-based are a small part of the overall cash balance plan, I look to the cash balance plans generally as being prevalent, and that this is a step towards addressing a piece of that prevalence. Thanks.
Okay, thanks, Fred. Christine?
Good morning. So I agree that there is a problem, that the measurement of the benefit obligation doesn't equal the amount that entities owe at the balance sheet date. So our current accounting is not doing a good job of reflecting the economics. I'm not sure that the problem is pervasive based on the data that the staff shared with us. I think 85% of these plans are very small with fewer than 24 participants. I would have expected that as a result of that this would have been a pervasive issue for private companies. And yet when we talked to the PCC, they said that this was not a pervasive problem within their space. I do believe that there are technically feasible solutions. I'm not sure that the scope is well defined. I'll come back to that a little bit later. But I think where we are in the process, I would support adding the project.
Okay, thanks, Christine. Hillary?
I appreciate the EITF bringing this issue to us and having some really thoughtful discussions and deliberations. I do agree adding this to the technical agenda. I do believe that the EITF made a case for the pervasiveness of this issue in the context of cash balance plans in general. And certainly I do believe that they've come up with feasible solutions that are going to allow us to be able to move forward here. So fully support adding this to the technical agenda.
Okay, and I'll make it unanimous. I'll support adding it to the agenda. I think we have uneconomic accounting for these plans today. And I understand the issue of pervasiveness. I try to look at this more in lines of, we have something in front of us. It's not a choice to do this or do another project. It's, we can do this and we can do other projects. And my reaction is, I do think we're going to continue to see these grow in prevalence, particularly when compared to traditional defined benefit plans. So I think getting ahead of this and addressing uneconomic accounting makes perfect sense at this point. So with that, back to you, Michael. You get to go on to question 2.
Thank you, Rich. I will now tee up question 2 related to scope. Paragraph 11 in the handout listed two alternatives identified for scope. The narrow scope alternative would only include a specific type of market return cash balance plans, while the broad scope alternative would include any defined benefit plan with promised benefits based on the expected returns on investable assets, including the market return cash balance plans in the narrow scope and certain variable annuity plans and foreign plans. The EITF recommended the narrow scope alternative because it was clearly defined, would limit any unintended consequences, and was a targeted solution directly responsive to the identified issue in the agenda request. A majority of EITF members also suggested that the board include questions in the proposed update on, one, whether there are other plans that are economically similar to market return cash balance plans that should be included in the scope, and two, the pervasiveness of those other plans. The staff agrees with the EITF's recommendation. The staff believes that the narrow scope would result in a targeted solution for a specifically identified issue and would limit changes to pension accounting. The staff also notes that the three conditions included in the definition of investable market return under the narrow scope are a subset of rates considered market rates of return under ERISA and IRS regulations. Therefore, the staff thinks that the recommended narrow scope would be clear and operable for entities. I'll now turn to the board to discuss question 2.
Any questions for the staff on question 2? Okay, not seeing any. Joyce?
Thanks, Rich. I agree with the proposed recommendation. As the research indicates, plan sponsors should be familiar with the conditions that are proposed since they are based on established regulatory requirements. However, I am interested in learning from stakeholders whether the proposed conditions to identify the characteristics of investable market returns are sufficiently comprehensive or appropriately narrow enough to meet the objective. And I mention this since the selected potential conditions of an investable market return in the recommendations were sourced from the tax legislation as well as ERISA, and they are a subset of that broader population of rates. And therefore, it's important for us to ensure that we've gotten that population of conditions right. So I think to help inform the appropriateness of the scoping criteria, I'm interested in stakeholder feedback, not only on the proposed conditions for the investable market returns that were selected, but also on those rates that were not selected under the regulatory requirements.
Okay, thanks, Joyce. Marcia?
First of all, I appreciate very much the work that the EITF did in trying to refine the recommendation. And I do support a targeted approach with a narrow scope. That said, I think that since we're embarking on an effort to improve GAAP, it's appropriate to ask the questions to make sure that the scope is not only workable, but that we have captured similar type plans with the scope the way it's defined. So I support all of that. With regards to what Joyce mentioned and the linkage to ERISA, et cetera, I actually liked the fact that the EITF recommendation was such that we weren't in GAAP trying to redefine a certain characteristic or interpret a new definition, and that the recommendation and the scope, et cetera, did already reflect what's well understood. And I think that helps make it much more workable.
Okay. Thanks, Marcia. Fred?
Thanks. I also support the narrow scope that the ETF voted in majority for. I thought it was a good EITF discussion because I think one of the questions for an exposure draft is, should we go broad with the exposure and potentially scale it back? Or if we do find an exposure draft that maybe there's some other plans, will it be possible for us to extend this type of accounting that, in general, I think could be appropriate for a lot of different type of plans that fall under the cash balance rubric. Nonetheless, I think the discussion was good, and I'll support the EITF with going with the narrow scope at this point in time.
Sue?
So I also agree with the recommendation of a more narrow scoped approach. I do like, as others have indicated, the alignment with ERISA and IRS. I do think that the discussion at the EITF, particularly between the camp that was more principles-based and the camp and a broader approach and a camp that was advocating for a more narrow scoped approach, was useful, because I think it helped to kind of frame what is the problem we're trying to solve, and do we have the right things scoped in? And I think what I learned from that is that, there could be some inherent consequences in scoping some additional type plans in. And secondly, I think that maybe what we heard isn't really that there's a known or pervasive issue at this point that would necessitate having a broad approach. But that said, I do think that there was some mention about foreign plans that could potentially be scoped out. So I do think asking a question in the exposure draft on other types of plans that might have similar economics would be useful, particularly for our research and redeliberations.
Thanks, Sue. Christine?
So I found the arguments in the memo convincing that there are some unique characteristics economically of the first two types of plans that are listed. So that would be the I and double I. But there was also a discussion in there that the third type of plan was really economically different from those and more similar to other types of cash balance plans that are excluded. So I had a hard time understanding why the line was drawn, where the line was drawn, why some things are in and why some things are out. So my hope is that the staff can provide a robust explanation as to what the economic similarity is between the plans that are in and the plans that are out. And I do think that it's important for us to ask a question about this.
Thanks, Christine. Hillary?
I appreciated the EITF discussion with regards to the scope of this issue. I definitely support the more narrow issue in this case. Certainly, I think that's more clearly defined. I'm not sure that I heard similar to what Sue said. There may be foreign plans out there that may not fit these criteria, but I don't know that we heard that there were definitive, pervasive number of those plans. I also think that it lowers the risk of unintended consequences. I think it's clear and it's operable. And as has been indicated, right, this is kind of leveraging off of criteria that's already in the IRS and ERISA regulation. So I think that was an important consideration for me. When I think of all three of these different types of returns, I think they're really getting to whether it's the return on plan assets or that approximates the associated cash balance plans, or the return on a regulated investment company, it's getting to a market return, right? Getting to the economics. Why are the economics of these plans different than other cash balance plans? So I am comfortable with all of those being within the scope of this guidance. And I do think this is a targeted solution for a specifically identified issue related to a narrow set of cash balance plans. And at this point, I'm comfortable keeping it narrow.
Okay. So I agree with the staff and EITF recommendation on the narrow scope on this. Also supportive of asking the question. I think one of the challenges here, particularly with the foreign plans, is unless someone brings them to us, it's going to be really tough for us to understand the different characteristics of those plans. So hopefully by putting this out there with the question, hopefully we get some actuaries involved because they're probably the most likely to know it in some of the companies. Maybe they can share with us their specific fact pattern. I think that's a lot more productive than asking you to go out there and try to find plans because I don't know. We'd have to go through the same type process of doing outreach for those entities. So supportive of the narrow scope and supportive of asking the question. With that, Lucy?
Great. Thanks, Rich. So I will now tee up questions 3 and 4 related to the measurement changes. Paragraph 12 of the handout listed 4 alternatives identified for measurement of the projected benefit obligation. Alternatives A, A1, and B were discussed by the EITF, while alternative C was identified during the staff analysis. Because the board just decided on the narrow scope, alternative A1 is no longer relevant because it would apply to broader scope defined benefit plans. The EITF recommended alternative A, which would use the assumed interest crediting rate as the discount rate to measure the PBO, because it would better reflect the economics of the in-scope market return cash balance plans than the current pension accounting and result in less volatility in the financial statements than alternative B. The staff noticed that under alternatives A, B, and C, the PBO would generally equal the plan's hypothetical account balance, which usually is different from the amount recognized under the current pension accounting. In addition, for a fully self-funded in-scope market return cash balance plan, all three alternatives would generally have the same net financial reporting impact without considering the plan's preservation of capital feature, annuity option feature, and other actuarial assumptions. The staff agrees with the EITF recommendation on alternative A because it is a narrower change to current pension accounting compared with alternative B, and it better reflects the characteristics of the in-scope market return cash balance plans compared with alternative C. The staff also recommends that the board require the assumed interest crediting rate to be used as the discount rate for the in-scope market return cash balance plans in all circumstances. The staff thinks that this would provide more comparable and consistent information to investors and align with the objectives of the EITF for this project. Some EITF members suggested that the board consider adding illustrative examples related to the effect of the preservation of capital feature on the plan. However, the staff does not think it is necessary or appropriate. As noted by some EITF members, it is complex to separate the impact of the preservation of capital feature from other actuarial assumptions in determining benefit obligations, and this feature is often insignificant in plan design in practice today. The staff also is concerned that adding this example is beyond the scope of the EITF issue. With that, I turn it back to the board to discuss questions 3 and 4.
Any questions for the staff on 3 and 4? All right, Marcia?
Again, I appreciate the extensive deliberations that were actually undertaken on these issues, and I am very comfortable with the recommendations in all cases. I also appreciate the work that was done to present the alternatives on the PBO, and I'm comfortable that the PBO that results from the recommended measurement alternative will be meaningful.
Okay, thanks, Marcia. Fred?
Thanks. I am also comfortable with alternative A. It was an interesting, because I thought the discussion was interesting, because if we use the, I think it's alternative B, we would get more transparency on a market disruption that would go through the income statement. So that was somewhat appealing. And the other thing, as was stated, the EITF, it would be lower cost. However, I think, to me, it was still compelling that, another non-cash charge going through the income statement that would be soon reversed, likely reversed, isn't terribly appealing. And also, I do think that the EITF recommendation that's essentially a minimal change to pension accounting was also. So I do support A. I think in terms of the using the assumed interest crediting rate, I think the analysis was helpful. At the end of the day, if you're discounting both the asset and liability, it really doesn't matter what rate you use. But I think intuitively, the assumed interest crediting rate is good to use, because I think it makes more sense than just picking any rate, although the result would likely be the same. Thanks.
Thanks, Fred. Sue?
So I also agree with alternative A. I think for many of the reasons, Lucy, that you described. I do think that one other reason why I like alternative A is that it is still aligned with topic 715, whereas alternative B and C are not. And also it's less volatile. I agree with you on what you said about the examples. I don't necessarily think that a example of a preservation of capital feature is necessary. I think what we heard from the EITF discussion is that isn't that common. And so I don't know that that's necessary. I think in terms of whether this should be required, I would require it. I think that's an important aspect of making the improvement in order to make sure that the information is comparable and consistent.
Okay, thanks, Sue. Joyce?
Thanks, Rich. I also support alternative A for the reasons that have been mentioned by, of course, the EITF and what the staff has articulated today. I think it's quite important that the liability associated with the pension obligation would be valued according to the expected benefit to be paid and not according to a bond market proxy, which is customarily applied under today's accounting. I think the economic and the actuarial alignment that would be created by setting the discount rate equal to the interest crediting rate would reduce some of that valuation noise over time that really doesn't reflect the real changes in the plan obligations. And you mentioned, of course, that we're not considering A1, but for those supporters of A1, I do believe it is important, as mentioned earlier, for us to add a question in the proposed guidance regarding the scope to learn, whether or not stakeholders identify other plans that economically are similar to the population that we're addressing today and guide whether further research should be conducted. Regarding alternative B, in my view, it falls short of reflecting a comprehensive present value of the obligation by not taking into account contractual terms, such as caps or floors or annuity features, essentially the actuarial assumptions. And in the event economic conditions are forecasted to significantly change over time, the actuarial assumptions under alternative A should capture the impact in the pension obligation, which in alternative B would not be taken into consideration, thus, in my view, not as economically faithful as alternative A in depicting that expected benefit to be paid upon retirement. Regarding alternative C, I viewed it as less preferable to alternative A since the effective settlement rate is not the rate in which the participants' benefit actually grows. And it's not a measurement of the liabilities that's consistent with the cost of settling the pension obligation. Regarding question 4, I agree the application of the assumed interest credit rate as the discount rate should be required. I think it would better address the objectives that were set out by the EITF. It could potentially enhance peer-to-peer comparability and consistency, as Sue has mentioned. It addresses the different interpretations that are underway today, and it should promote similar treatment for economically similar pension plans.
Okay, thanks, Joyce. Christine?
My first choice would be to measure the benefit obligation equal to the total of the hypothetical account balances in the plan on the balance sheet date. So that would be alternative B. I think the objective of all 3 of the alternatives that you're looking at is to approximate the balance of the hypothetical account balances at the balance sheet date. And so I think that just using that amount would be simpler. I think it'd be easier for investors to understand. According to some EITF members, it would be less costly. And I think it actually does a better job of reflecting what the entity owes at the balance sheet date. That logic is similar to the same logic that I applied when we recently made the decision under environmental credit programs to not consider future actions or future outcomes in the measurement. I'm not concerned about the risk of undue volatility as a result of that, because, as I said, the objective of all of these is to try to approximate that amount. And it's my understanding that generally you would get to the same number, except when there is market dislocation, and those should be relatively rare occurrences. So I don't anticipate that setting the balance equal to the hypothetical account balances would result in a lot of volatility from one period to the next that would be any different from what we would see under the EITF's preferred solution. I'm also not concerned that it doesn't take the annuity option into account. One, because I think I read somewhere that it's pretty rare that these participants take that option. But secondly, certainly it would have helped to have some information from an actuary to know what the magnitude of the impact would be of taking the annuity into account. But unless one of the parties to the agreement is systematically leaving money on the table, I have a hard time understanding how the lump sum and the annuity amounts would be significantly different from one another systematically. So I was struggling with that as being a significant concern. Now, I recognize that accounting is quite different than defined benefit plan accounting, but I think it was Fred that said at the beginning of the discussion, one of the problems with these plans is that they are accounted for as DB plans, but they're not DB plans. And, I think sticking with essentially the wrong model and then trying to fix it mathematically, which is what alternative A and alternative C do, is not sort of the best approach for the long term. But that said, if we are just going to put a mathematical Band-Aid on the defined benefit model for these types of plans, then I would prefer to put the Band-Aid of alternative C on the problem, because I am concerned that it is risky for us to open the door to using asset rates to measure the present value of liabilities. And I think once we go down that path, we may have a hard time defending that decision when future requests come in other circumstances to use that type of rate to calculate the present value of a liability. So I just think that from an exposure perspective, alternative C gets us to the same outcome as alternative A, but without crossing that bridge of using asset rates to discount liabilities.
Okay. Thanks, Christine. Hillary?
I agree with the EITF recommendation and the staff recommendation of alternative A, so setting the discount rate equal to the assumed interest crediting rate. I do believe that's a better reflection of the economics for the in-scope plans that we're looking at here. I also think that it is holding true to the principles of pension accounting that exist today. So it's less of a fundamental change in more of a reflection of the different term associated with this type of cash balance plan. So I think it is a targeted improvement to help increase or better reflect the economics of the in-scope programs without having to make significant changes to the pension model in general. Certainly, I think that moving to like the walkaway approach or alternative B, I think is a fundamental departure from where we have been. And to me, I would only be comfortable looking at that more broadly rather than on narrow specific issues. So certainly, I think that's something that if we want to relook at pension accounting, that's a board project, not the scope of an EITF project. So here I'm really looking at focusing on the targeted improvements for the specifically identified issue here. And I wouldn't agree with alternative C. I think this is a item that has been deliberated, across the pond, right, from an IFRS or an ISB perspective. And certainly, while I understand you might mechanically get to the same answer if you're using the same amount, right, from a discounting and a projection and a discounting perspective, I don't think that using the high yield bond rate is a better reflection of the economics, right? And I do think you're going to end up with more actuarial gains or losses being recorded if you have a disconnect between that and the plan assets. So from my perspective, I think alternative A is to me the best reflection of the economics in a way that's going to be able to be understood by investors.
All right. So I'm also supportive of alternative A. When it came to alternative B, I must admit it initially had some appeal, but then I went back to, I think we're accounting for the plan versus the individual's obligation. And when you account for the plan, rightly or wrongly, pension accounting is based upon the timing of payments. And it's not based on a balance sheet cutoff. And maybe that's something we should revisit, and non-vested pension obligation should be zero. But that would be a huge change. And there is an annuity here. It's in there, particularly in ERISA it's, I believe, required to be in there on these plans. And so to then ignore it, I do struggle with. And I think that's the problem the board's had in the past. I think the other issue under alternative B is that is different than the amount that theoretically you would pay a third party to assume the obligation. And that tends to be more how those are valued. And a third party would factor in the timing of the payment. They wouldn't assume everyone quits on that day. So for that reason, there's some appeal there, but I do think it would really cause us to revisit all of pension accounting and what's really obligated at a balance sheet date, which in many cases is zero. C, I looked at for similar reasons. Well, I certainly understand it gets you to the same obligation related to that individual calculation. It does seem like it would create larger actuarial gains and losses if you look at the difference between the projected credit from a discount rate versus the asset rate of return that you're expecting. It would seem like hopefully you can make a decent estimate and you're going to be closer, which would seem to minimize those, I think. But, I'll be interested. I do think on the scoping issue, if we're going to ask the question on do we have the right scope, since Lucy, as you mentioned, you said it effectively our scoping decision got rid of alternative A1. We should make sure we ask the question also, if you feel we have the wrong scope, do you think we would need to revisit this issue? So I would just combine that in there to make sure we get all the input that we need at this time. And yeah, you didn't vote on required either. So, and
Sue's the only one. That's.
all right. So, and yes, I would think it should be required. So show of hands, does everyone think it should be required? I've got unanimous. So for anyone just listening.
Sue and Joyce.
I thought we started well. So Lucy, back to you, questions 5 and 6. And we'll
Great.
cover both this time.
Yeah, so now I tee up questions 5 and 6. Question 5 relates to the consequential amendments. The staff recommends that the board make consequential amendments to the guidance on cash balance plans in paragraph 715-20-25-3 to clarify that the general principle for cash balance plans in that paragraph still applies to in-scope market return cash balance plans. In addition, the staff recommends that the board make consequential amendments to the guidance on the measurement of accumulated benefit obligations in subtopic 960-20 to require the assumed interest crediting rate to be used as the discount rate as well in calculating the ARO of the in-scope market return cash balance plans for the purpose of plans financial statements. Moving on to question 6 on entity applicability, the EITF recommended that the proposed changes made under this project apply to all entities as opposed to an accounting policy election, noting that both public business entities and other entities have in-scope market return cash balance plans. The staff agrees with the EITF recommendation. I will now turn back to the board to discuss questions 5 and 6.
Lucy, the extension to the actual plan accounting of the same discount rate, that wasn't part of the EITF discussion, correct?
Correct.
Did we get any, I understand principally why it makes sense that the plan's financials should look like the company's accounting for the plan. Did we get any feedback? Were we able to do any outreach on whether that creates any issues in the plan financial statements under ERISA?
Yes, we did limited outreach with a ERISA expert on the
Okay.
AICPA employee benefit panel, and we confirmed there's no conflicts with the ERISA regulations or IRS regulations or other laws if we make changes to the 960-20 on the
Okay.
discount rate.
And when you mentioned unintended consequences, that would be one of the questions we would ask more broadly in the exposure
Yes.
draft. Okay.
Yep.
Thank you. Any other questions for the staff? Okay, Sue?
Thanks, Rich. So on the consequential amendment on to 715, I agree with that. I think it's a good change. It's good alignment. On the amendment to 960, I do like the consistency element and I will support it. I do think we should maybe include during the exposure draft period, maybe a broader discussion with the expert panel than just the one individual. And perhaps outreach with the DOL as well, since they use this information, just to be sure as one user of a plan financial statements. We often have consulted with them in the past on things like this, so I think that's a prudent thing to do. And then as it relates to applicability to, I would agree with all entities, all plans. I do think this is more of a private company issue, I believe, but maybe not. But I think it's all entities.
Thanks, Sue. Joyce?
Thanks, Rich. So regarding question 5, I agree to propose the consequential amendments. The first one related to 715 is a clarification, and I think it should be helpful to the plan sponsors understanding and applying the proposed guidance. As it relates to the alignment of the accounting between the plan accounting and the sponsorship, I think that it's great that we can attempt to get some symmetry there. As Rich and Sue have mentioned, I think it is quite important that we learn whether or not there are any unintended consequences in this regard. So a broader reach and understanding any implications, I think, would be important. As it pertains to question 6, I agree with the staff recommendation. It's applicable to all entities, and I think some of your research has indicated that there is the potential for future growth in these cash balance plans, and they clearly can touch a diverse range of entities, and so therefore I think the scope should be broad here.
Thanks, Joyce. Marcia?
Yes, I agree with the consequential amendments. I also agree with the fact that getting outreach, I know when we do the final deliberations, I'll be interested in learning what we've heard from actuaries. I like Sue's suggestion about reaching out to the DOL. I think it's appropriate to search for this alignment. I also think it's appropriate to leave no stone unturned to make sure we don't have any unintended consequences as a result of trying to do the right thing with the alignment. And I also agree with the recommendation that this apply to all entities.
Okay. Fred?
Yes, I agree with adding the consequential amendments. I think it's important to ask that question, make sure that there aren't other areas that we need to ensure alignment. And on question 6, like Sue, all entities, all plans.
Christine?
I agree with the staff recommendation on both questions.
Hillary?
I also agree with the staff recommendation on both questions with the additional outreach as we just discussed.
So for me, yes, and yes, supportive of the outreach. So with that, over to Zach. Good morning, Zach.
Awesome. Thank you, Rich. I'll now cover question 7 on disclosures. The EITF recommended that the board not require any additional disclosures beyond those that are currently required for defined benefit plans under topic 715. The staff agrees with the EITF's recommendation, and the staff also notes that the current guidance in topic 715 includes disclosure requirements on various aspects of defined benefit plans, such as the key assumptions used to determine the PBO, the expected benefit payments in future years, and the best estimate of contributions to be made in the next year, the roll forward of the PBO and plan assets, and an explanation of significant gains and losses related to changes in the PBO or any other significant change of the PBO and the plan's assets. The staff thinks that the current disclosure guidance is sufficient to provide investors with transparent and relevant information about an entity's in-scope market return cash balance plans. Some EITF members suggested that the board include a question in the proposed update on whether additional disclosures regarding the impact of the preservation of capital features on a plan should be required for in-scope market return cash balance plans. The board can consider adding such a question in the proposed update. With that said, I'll now turn it to the board to discuss question 7 in the handout.
Okay, any questions for the staff? Okay, Marcia?
Yes, I agree with the recommendation as it relates to the disclosures. I think we often hear that the current disclosure requirements as it relates to pension plans is rather robust. I think it's complete. I also think that, as we've said before, this is a very targeted improvement. Again, not to modify or significantly change anything with regards to pension accounting, but to specifically provide guidance on how to apply pension accounting to a very narrow set of plans. So I don't think that triggers additional disclosures.
Fred?
Thanks. I also support the staff recommendation on this. I do think that discussion was interesting at the EITF because it was quite clear that some investors didn't fully appreciate what was required today. So I think in the question, because I think it's important in the question to lay out what is required today and then ask if there's further information that is missing that investors feel they need, because I think that was important to flesh out what is already currently required in that question. Thanks.
Sue?
So I also agree with the staff on this one. I think that, much to Marcia's point about the robustness of the pension disclosures, I don't think that incremental disclosures are necessary.
Okay, Joyce?
I agree with the staff recommendation, and I like Fred's suggestion. The staff has identified already a relevant population of disclosure requirements that address pension plans, notably pertaining to key assumptions used to determine benefit obligations. I think that exercise that you've done could certainly be appreciated by others. And while there isn't a requirement to disclose discount rates of distinct benefit plans separately, I think it's important to note that under 715, 30, 35, 45, that entities should apply a judgment to make that disclosure determination. I think that emphasis is important there, given this is such a distinct and unique set of requirements under this plan. But in spite of not necessarily requiring additional disclosure, I think we should add a question to the proposed guidance, specifically addressing the sufficiency of the disclosure and perform outreach with investors as part of the comment letter feedback process, since, as we know, investors traditionally may not necessarily reply to a comment letter, and I think this is the area that they would be keenly focused on.
Sue? Did I call on you already? You want to vote twice? No, just kidding.
I think I only get one.
Christine?
So I think when the discussion came up about disclosures with the EITF, really the focus was on the preservation of capital and whether there needed to be additional disclosures around assumptions related to the preservation of capital. I didn't get a sense that there was a broader request for additional disclosures with respect to these plans. And it seems that the existing disclosures will suffice in that instance. So I would not add a question at this point. I think for a couple of reasons. One, it's going to require us to go through and explain what all of the existing disclosures are. And then ask a question which we are unlikely to hear back from investors on anyway. And then even if we were to hear from a couple of people that said, oh yeah, we think you should add this additional disclosure, we know that that's really hard for us to do in redeliberation. If we really think that there is a disclosure that would be helpful to investors, I think we should add it and then ask a question if it should be taken out. That's easier for us to do in redeliberation. But barring our concern that there is a specific disclosure that is missing, I would not ask a question.
Okay, thanks, Christine. Hillary?
I agree with the staff recommendation to not require additional disclosures. I think there was a really robust discussion in the EITF meeting, and I think some of that discussion was educational in nature, right? And I think it's fair in, whether it's the basis for conclusions to make sure that we make that connection of how these elements are already included as part of the existing disclosures, which might make it easier for an investor to kind of make that connection back for purposes of the question. I do agree with Christine if I wouldn't ask a specific question related to the preservation of capital feature for many of the reasons that Christine noted. I also think the preservation of capital feature isn't specific to market return cash balance plans, right? That is defined benefit plans, right? And so I do think that if we hear broadly more concerned with regards to whether or not additional details required there, I think that should end up in a broader kind of disclosure effectiveness project or something. I don't think that that's necessarily the point of the targeted improvements in the EITF issue. So I wouldn't want to ask about adding a broader, type of disclosure which may impact those beyond the scope of these particular plans.
So I agree with the EITF recommendation. I wouldn't add any incremental disclosures. I think it's questionable we'll get much feedback on a question, so I'd probably avoid it if we could. People aren't shy when they have views on our documents beyond the questions we've asked and sharing them, so I think they would. And I keep coming back to the company's doing the accounting for their interest in the plan, and when there's a settlement or a curtailment, those major events, we have other accounting guidance and other disclosure requirements. So you almost can't even deal with this just and we have actuarial assumption changes all the time and disclosure of those. So it's going to get really messy, which is one of the criticisms we hear about pension disclosures today is you get a lot of information, but it's really hard to understand that unless you understand pension accounting. And so the long way of saying, yes, I agreed not to require incremental disclosures. Back to Zach.
Thank you, Rich. I'll now tee up questions 8 and 9 related to early adoption and transition, respectively. The EITF recommended that early adoption be permitted at any point an entity runs its next actuarial pension calculation, and that entities be allowed the option to adopt the proposed solution either A, retrospectively, with a cumulative catch-up adjustment at the beginning of the earliest period presented, or B, prospectively, at its next pension remeasurement date during the year of adoption. The staff agrees with the EITF's recommendation on both early adoption and transition, although the staff does acknowledge that the benefit of applying the retrospective transition approach may not justify the costs. In addition, the staff recommends that the board require relevant transition disclosures based on topic 250 for both the interim reporting period, if applicable, and the annual reporting period during the year of adoption. The staff believes that those transition disclosures listed in question 9 on your handout, in combination with the general disclosures required under topic 715, would provide investors with sufficient information related to the effect of the adoption of the proposed guidance. I'll now turn it back to the board to discuss questions 8 and 9 in the handout.
Okay. Just a question on retrospective. So for retrospective, right, you would go to the earliest period presented and you would adjust your discount rate at that date, right? Because chances are you're already using the projected crediting rate. And a change in a discount rate is a change, it's an actual change in actuarial assumption that then gets put into the corridor. So retrospective application doesn't get you to as if you were always applying this pension model. It just gets you to as if you made the change in an earlier period, correct? Because if you have, let's assume you have a 10-year corridor, you still have the effects of the other discount rate rolling, changes in that discount rate rolling through the corridor in some portion, right? 10 years, 9 years, 8 years, 7 years. And so unlike what we usually think about of retrospective, this doesn't get you to as if you've already always applied it. You will still have noise coming through in your income statements. Is that correct?
That's correct. It's a full set flush of all the
But it doesn't get you to as if you've always applied this discount rate. Your P&L is still different because of the effects of the corridor unless you're on immediate recognition.
That's correct. I think the balance sheet will true up, but P&L, like depending on the corridor method. Yeah.
Is still, because I think that's important because usually when we think about retrospective, we think we've gone back and your P&Ls are comparable. And that will not be the case here, right? Unless someone's on immediate recognition for changes in actuarial assumptions. Okay, thank you. Christine?
Yeah, I just want to clarify my understanding that on transition, if I have a gain as a result of the change in measurement, as someone moves from the old measurement basis to the new measurement basis, if they are immediately recording those actuarial gains in income, if that's their policy, then there will be an immediate non-cash impact to the income statement as a result of transition. I mean, I know it could be gain or loss, but the reality is
It will hit the
it's
P&L.
likely going to be a gain just because for, where we stand currently in terms of where rates are and whatnot. So,
Yes, I believe so.
okay.
Yeah.
And there won't be any disclosure regarding that amount. Is that right?
No separate transition disclosure.
Right. Okay. Thanks.
And now just to go a little further, so if I do it prospectively, my next actuarial measurement, I'm going to have a change in my discount rate, right? From my old rate to my new rate. And well, that's going to true up my balance sheet. That's then going to go into the corridor. And I thought during the EITF meeting, or maybe it was the EITF education session with one of the actuaries, we asked, do people typically, have they moved to immediate recognition of actuarial gains and losses on these plans, or do they tend to still have a corridor? And we were told they still have a corridor. That's what I recall.
Yeah, I think most of the cases people are still applying the corridor rather than mark-to-market approach.
Okay, so there's no, on a prospective application, there is no immediate effect of that change. And it would be disclosed like any other change in actuarial assumption under the existing pension rules.
Right. If they select corridor approach, the
Yes.
assumption will apply to the next
Yep.
years as part of the actuary.
Okay.
Yeah.
That's enough. I got it. Okay, thank you. Any other questions? All right, Sue?
So thanks, Rich, and thanks for that discussion. I had similar concerns about the complexity of retrospective application and sort of the mechanics. And for me, I think that it's overly complicated. I don't really see a lot of utility in providing that, and the complexity and the cost associated with it. It's hard for me to fathom that anybody's actually going to go through that exercise. But for me, I would prefer we just require one transition methodology, which is prospective. And I would support early adoption.
Okay, Joyce?
Thanks, Rich, for that discussion. So I support the staff recommendation for early adoption and the various approaches. I think some entities may find that the retrospective approach could be relevant to their users. So making the retrospective option available, I think, is appropriate. But that being said, under the retrospective approach, the peer-to-peer relative comparability could be limited since peer organizations may make different choices. And given the potential complexities and costs in recasting the information, and potentially the limited utility, as Rich is pointing out today, of that prior period information to users, there may not be broad application of the retrospective approach. But I would support giving the option to the entities.
Thanks, Joyce. Marcia?
Yes, I support early adoption. As it relates to the EITF deliberations, I just want to make a shout out, even though I know this isn't in the final recommendation, but I did appreciate the conversation of the modified retrospective approach because it was an attempt to focus on cost-effective applications. So I thought that that was a worthwhile deliberation. I understand all the reasons why that didn't move forward as an alternative, but it spoke to me in principle. So I just wanted to acknowledge that. As it relates to this specific case, I agree that the likelihood a retrospective application is going to be chosen. So I absolutely agree with the prospective. The likelihood that a retrospective, someone's going to choose to do this retrospectively and incur the actuarial activities to go back and restate things, I think is very, very low. So I could support if we were to make this prospective only. However, I think that would be unusual for us to do when I look at the types of improvements that we make in the past. So I definitely, despite my appreciation for the conversation of the modified retrospective, agree that this issue does not warrant 3 alternatives. I could actually support a single alternative being prospective because I think that's going to reflect reality. But I understand if we want to stick with our pattern and still permit retrospective, that we would do that. So I don't know how that helps you with the vote count because I'm giving you 2 votes.
Well, I
If
put
we-
you,
if-
I
if
put you
we
as
get-
both.
You put me
I'm gonna put
as
you down
both.
as both.
Okay, because if there were others that agreed that prospective seems to make sense, I would support that.
Okay,
So
got it. I'll come back to you at the end. Fred?
Thanks. On 8, I do support early adoption. On 9, I am with Sue. I think prospective transition only. I think it's unlikely the retrospective would be used. It's awkward. And also I am sensitive to Christine's question that you could get undisclosed gains if somebody actually chose that. So I would just do prospective only. Thanks.
Okay. Christine?
So I also think 3 transition approaches, given what we're discussing here, is overkill. I would just go with perspective, and I agree with early adoption. And are we supposed to be answering question 9 on transition disclosures as well? I thought so. So I'm fine with staff recommendation on transition, although I do continue to be concerned about the lack of disclosure around the gain that could go through the income statement in one fell swoop. But again, I think it's going to be a relatively rare situation.
So I'm missing transition disclosure, staff recommendation.
I agree with the staff on
Joyce?
prospective.
I agree with the staff.
I agree with the staff.
Fred? Okay. Hillary?
On question 8, agree with early adoption. With regards to transition, I believe there's 2 ways to do this in an exposure draft. You could either say that retrospective and prospective are both permitted and get feedback there, or you can say it's prospective and ask whether or not retrospective is necessary. It was a very robust discussion on transition at the EITF meeting. And while I do appreciate the discussion with regards to, well, why would we stop anyone from applying it retrospectively if that was their choice? I do think the cost and complexity discussion that we had there really makes me hesitant that people are going to apply this on a retrospective basis. Now, I have no concern with asking whether or not retrospective application is necessary. That's something we can easily add in from a redeliberation perspective, right? That's just a choice that we can make based on the feedback that we receive. But I do think I heard a lot of feedback, to say that there's cost and complexity and maybe potentially limited utility of information that's provided by a retrospective transition option. So I would support prospective only and ask a question of whether or not it's necessary to include a retrospective application. And I agree with the staff recommendations for the associated transition disclosures based on where the vote goes.
Okay. So supportive of early adoption, prospective only. I think this is a change in discount rate, and there's an accepted model for changes in discount rates, and I think doing it prospectively just puts it into that model, which is well understood. I think anyone responding to this who wants to do it retrospectively in some form will certainly tell us they think they should do it retrospectively. So, and as far as disclosures, I'm fine with the prospective transition disclosures. And then with that, let me welcome Ari for questions 10 through 12. Ari?
Thank you, Rich. I will be teeing up questions 10 through 12. Based on the EITF's discussions, the staff believes that the recommended changes to the measurement of the PBO of the in-scope market return cash balance plans would A, better reflect the economics of those plans, and B, eliminate different interpretations in practice about how the measurement guidance in subtopic 715.30 is applied to those plans. The staff does not anticipate that entities will incur significant costs to implement the recommended changes because the interest crediting rates of in-scope market return cash balance plans are readily available to entities with those plans, and the adoption of the proposed guidance would likely not require significant resources or processes beyond entities' regular actuarial pension calculation and reporting processes. Therefore, the staff thinks that the expected benefits of the recommended changes would justify the expected costs. Considering the impact of the proposed amendments on pension accounting under topic 715 and subtopic 960.20 and the need to identify other types of defined benefit plans for potential measurement changes as requested by the EITF, the staff recommends that the board provide a 60-day comment period. I will now pass it back to the board to discuss questions 10 through 12.
Okay. Any questions for the staff? All right, Marcia?
Yes, I have sufficient information. Yes, I agree that the benefits justify this. I give the staff permission to move forward, and I am comfortable with 60 days.
Joyce?
Question 10, yes. Question 11, yes. And I give the staff permission. I think the recommendations address the issues that were identified by the EITF to improve the economic depiction of these plans and financial reporting and address the varied interpretations in practice. I think the analytical relevance of financial reporting should improve as a result of these potential changes. I also think that as a result of there not being any incremental disclosures proposed, and that this is so narrowly scoped that entities should not have burdens in terms of additional processes or significant changes in their respective processes, or allocating expertise or resources towards this change. So in my view, it is definitely cost beneficial. And I agree with the 60-day comment letter period in that I think it should be sufficient time for companies to perform the analysis specifically relating to the scoping conditions, because I think that would be an important analysis to learn whether or not there are any economically similar plans out there that potentially should be considered as part of our project. And I think given the expected timing of this particular proposal's release, that the June 30 year-end entities who seek to respond to this proposal should be less restricted in their ability to respond if we allow 60 days rather than some lesser amount of time. So I also think that, as I mentioned earlier, that it would be beneficial to perform outreach with investors to ensure that the disclosure requirements that exist today sufficiently cover what they deem is relevant to this specific population of benefit plans.
Okay, thanks, Joyce. Sue?
So question 10, I have received sufficient information and analysis. And question 11, I think the expected benefits justify the costs. And I give the staff permission to ballot. And I think 60 days is sufficient.
Okay, Brian?
Yes on sufficient information, yes on benefits exceeding the costs, and I support 60 days.
Christine?
So I think there are still open questions on whether the scope is the right scope, but I think that we'll gather information on that through the exposure draft process. And that's why I support the 60 days to ensure that we do have an opportunity to gather feedback on that, as well as some of the other questions that we're asking. Yes, on permission to ballot, and yes, on cost benefit.
Okay, Hillary?
Yes, that I have sufficient information. Yes, I believe that the benefits outweigh the costs. I think this is going to be a better reflection of the economics for the in-scope market-based cash balance plans, and appreciate the EITF bringing this issue to us. I also agree with moving forward to issuing a ballot on the proposed ASU. And I do believe 60 days is sufficient. I do think this is a situation where sometimes with EITF issues, we can have shorter comment periods based on the narrow nature of these topics. But I do believe this topic warrants additional time for our stakeholders to provide feedback. And I think 60 days is appropriate.
Great, thanks, Hillary. So on question 10, yes, I've received sufficient information. Yes, I believe the expected benefits justify the expected costs. And I support moving to a ballot. 60 days is a fine comment period. And I'd just like to extend my thanks to the EITF, as well as certain experts, actuarial and otherwise, that helped us, one, identify the issue, but two, work through the issue. I think this is a good example where people who see these and see them on a regular basis or more regular basis were able to provide us insights into these that would have taken us much longer to accomplish on our own. So do want to thank the EITF for all that process. And with that, that concludes today's meeting. Thanks, everyone.